Hello and welcome to Fortrade Limited. In this video I'll be talking about technical analysis. If you've just started out in Forex, technical analysis can seem difficult to understand, but it doesn't have to be. And by the end of this video you will hopefully have a better understanding of the technical side of trading. Firstly, remember that technical indicators don't predict the future. Strictly speaking, they reflect what happened to a price of a financial instrument in the past, assuming that a price reversal will occur or the ongoing trend will continue. The basic idea is to identify trends based on the present and the past. There are two main types of markets depending on the price pattern on the chart: trending and range-bound or sideways markets. A trending market moves in one direction like this. A range-bound or sideways market is moving up and down within a specific range. When prices are not showing a specific trend, it can be difficult to estimate which direction the price will go. For that reason, we are using technical indicators. First, we are going to talk about moving averages. I'm just going to explain the basic concept and the way to choose options on the platform to suit your trading style. The most frequently used MAs in trading are SMA and EMA, so we'll focus on them. SMA simply takes the sum of all of the past closing prices over a time period and divides the result by the total number of prices used in the calculation. For example, a 10-day simple moving average takes the last 10 closing prices and divides them by 10. A 50-day simple moving average takes the last 50 closing prices and divides them by 50, and so on. The 10-day moving average is more responsive to price changes than the 50-day MA. In general, traders can increase the responsiveness of a moving average by decreasing the time period and smooth out movements by increasing the period. The exponential moving average leverages a more complex calculation to smooth data and places a higher weight on more recent data points. While the calculation is beyond the scope of this tutorial, you should remember that the EMA is more responsive to new information relative to the simple moving average, as it focuses more on most recent prices. An EMA is used to capture shorter trend moves due to the focus on most recent prices. By this method, an EMA is supposed to reduce any lags in the simple moving average, so the fitting line will hug prices closer than a simple moving average. EMA works well until prices break the fitting line. During higher volatility markets, you could consider increasing the length of the moving average term. One can even switch from an EMA to an SMA, since the SMA smooths out the data much better than an EMA due to its focus on longer-term moves. How to use moving averages. Moving averages are helpful for identifying current trends and support or resistance levels, as well as generating actual trading signals. The slope of the moving average can be used as a gauge of trend strength. In fact, many momentum-based indicators look at the slope of the moving average to determine the strength of a trend. Many technical analysts often look at multiple moving averages when forming their view of long-term trends. When a short-term moving average is above a long-term moving average, that means that the trend is higher or bullish, and vice versa for short-term moving averages below long-term moving averages. Moving averages can also be used to identify trend reversals in several ways. Price crossover. The price crossing over the moving average can be a powerful sign of a trend reversal, while the price crossing above the moving average indicates a bullish breakout ahead. Often traders will use a long-term moving average to measure these crossovers, since the price frequently interacts with shorter-term moving averages, which creates too much noise for practical use. Short-term moving averages crossing below longer-term moving averages is often a sign of a bearish reversal, while a short-term moving average crossover above a long-term moving average could precede a higher breakout. Longer distances between moving averages suggest longer-term reversals as well. For instance, a 50-day moving average crossover above a 200-day moving average is a stronger signal than a 10-day moving average crossover above a 20-day moving average. The Relative Strength Index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, it ranges from 0 to 100. An instrument is deemed to be overbought once the RSI is approaching the 70 level, meaning that it may become overvalued and is a good candidate for pullback or reversal. Likewise, if RSI approaches 30, it's an indication that the instrument may be getting oversold and therefore likely to reverse. Traders often use the RSI either coming back out to its overbought or oversold areas as a signal or a partial signal to enter a trade. Tips on using the RSI indicator. Sudden large price movements can create false buy or sell signals when using the RSI. It is therefore best used with modifications to its application or in conjunction with other confirming technical indicators. Some traders, in an attempt to avoid false signals from the RSI, use more extreme RSI values as buy or sell signals, such as RSI readings above 80 to indicate overbought conditions, and RSI readings of below 20 to indicate oversold conditions. The RSI is often used in combination with trend lines, as trend line support or resistance often coincides with support or resistance levels in the RSI reading. Watching for divergence between price and RSI indicator is another means of refining its application. Divergence occurs when a security reaches a new high or low in price, but the RSI does not reach a corresponding new high or low value. Bearish divergence, when price reaches a new high but the RSI does not, is taken as a sell signal. Bullish divergence, that is interpreted as a buy signal, occurs when price reaches a new low, but the RSI value does not. I hope that you found this video useful, and please join us again at Fortrade soon.